Okay, let's unpack this deep dive. We were plunging into the world of Żabka Group, a name that's become incredibly familiar if you've spent any time in Central Europe, especially Poland. Think about a retail network processing over 4.1 million transactions every single day.
Wow. That scale is phenomenal, isn't it? It really gives you a sense of how integrated they are into daily life for, well, millions of people.
It really does put it into perspective. And you might have noticed their profile got a huge boost recently. We saw one of the biggest initial public offerings, or IPOs, on the Warsaw Stock Exchange in years, back in October 2024.
Yeah, a very significant event for the company and for the Polish capital market overall. It signals, a new level of visibility and access to funding.
So Żabka, officially Żabka Polski, isn't just like a simple corner shop chain, is it? Our sources describe it as a leading force in modern convenience retail. It's headquartered in Poznań, Poland, with a colossal network that's now over 11,000 stores, primarily across Poland, but also growing fast in Romania.
That's right. And these stores, which are largely run by independent franchisees, they offer a really diverse range of things. It's everyday groceries, absolutely, but increasingly it's also about quick meals.
The Żabka Café and that QMS range.
Exactly. Quick meal solutions, fresh coffee, and a whole host of services. And after that IPO, well, they're valued in the multi-billion zloty range. Big numbers.
But here's where it gets truly fascinating, I think. Żabka isn't content just being physical stores. They see themselves and strategically describe themselves as a tech-powered convenience ecosystem.
That's their core strategic concept, yeah. And it explicitly goes far beyond just the bricks and mortar shops. It includes their incredibly popular Żabka mobile app, which is like the gateway to their world, really.
Right.
Plus their innovative unmanned Żabka Nano stores, e-grocery platforms like Juice and Dietly, and even direct meal services like Maczfit and Dietly.
So they're aiming to weave themselves into your daily routine, essentially, making things easier, saving you time, catering to multiple needs in one go, whether you're physically in the store or interacting digitally.
Yeah, and this isn't accidental. It's backed by serious strategic investment in technology and, crucially, data analytics.
And it also plays a big role in Polish entrepreneurship, right?
Yeah.
Through that massive franchise model, empowering local business owners all over the country.
Definitely. So that IPO wasn't just about past success or, owners cashing out. It was clearly framed as fueling their next big phase of growth.
Right, pushing further into international markets and doubling down on that tech and digital integration we just talked about.
Exactly. So our mission in this deep dive is, well, to take the stack of information you've provided us and explore this transformation. We'll look at how they got from being, a Polish retailer to this tech-driven giant that went public. We'll unpack their history, understand their complex business model, look at how they're performing financially, focusing on the key trends, see their place in the competitive market, dive into their future plans, and examine the risks they face.
The goal is to give you a solid, comprehensive understanding of Żabka Group, straight from the sources we have in front of us.
Ready to jump in?
Absolutely. Let's start by tracing their journey and seeing where this whole story began.
Okay. So Żabka got its start back in 1998, founded by Polish entrepreneur Mariusz Witalski, right there in Poznań.
What was he seeing in the market at that time? Was there a specific gap he was trying to fill, or?
Yeah, he saw a real opportunity. The existing local shops were often older, maybe less convenient. His vision was to introduce a modern, standardized convenience format across Poland, something that felt new and modern, kind of drawing inspiration from successful international chains like 7-Eleven.
Okay.
And a key part of the early concept was also to simplify starting and running a business for local entrepreneurs through a structured franchise system.
And that vision clearly resonated because it took off quickly. The sources note 7 stores opened in 98. By 2005, they already had 1,700 stores across Poland. That's incredibly rapid early growth.
It really shows the market demand for that modern format. And that rapid growth was enabled and sort of shaped by a series of key ownership transitions over the years, each one bringing a different strategic focus and investment scale.
Right. We see Penta Investments acquired them in 2007. There was a brief venture into the Czech Republic, which was later sold off to Tesco around 2010, 2011.
Then came Europa Partners in February 2011. Now, this period under Europa is described in the sources as highly transformative. They're really focused on consolidating the fragmented Polish convenience market and significantly accelerating Żabka's growth trajectory.
They weren't just opening stores. They aimed to double the rate of new store openings, didn't they? From about 200, 250 a year.
Exactly. And importantly, they back that ambition with substantial investment, 60 million of additional equity poured into new locations, but also crucially into building out their in-house logistics operations.
Right, getting that backbone sorted.
Yeah, implementing a new ERP system, which is basically the central nervous system connecting things like inventory, finance, store management, all that stuff, and enhancing their overall IT capabilities.
The results under Mid-Europa were dramatic, according to the sources we have. The network nearly doubled from around 2,300 to 4,500 stores.
Huge jump.
Revenue tripled to 1.5 billion, and operational profit, adjusted EBITDA, saw an almost four-fold increase to 100 million. Plus, that significant rebranding in 2016.
That period really highlights how strategic private equity involvement, combined with a clear plan and capital, can just supercharge growth and operational professionalization for a business like this.
Then, the next big turning point.
Yeah.
CVC Capital Partners acquired Żabka in February 2017.
That was a massive deal, valued between $1 billion and $1.5 billion, reportedly the largest retail and private equity deal in Polish history at the time.
Wow.
And under CVC, the growth accelerated even further, with the network expanding from 4,500 to over 10,500 stores by the time of the IPO. And CVC really championed the push into technology and digital innovation, laying the groundwork for the ecosystem we see today.
This is where we start seeing some really pivotal milestones and compelling demonstrations of their adaptability, like the challenge posed by the March 2018 Sunday trading ban in Poland. For a convenience retailer, that could have been a huge obstacle.
It absolutely was a disruption, but Żabka's response demonstrated, remarkable adaptability. They weren't just reactive, they strategically pivoted. They increased their focus on self-checkout in existing stores and, crucially, pioneered automated unmanned stores under the Żabka Nano banner.
Leveraging cloud platforms like Microsoft Azure, right?
Exactly, to power the technology. Offering postal services was another clever move. Stores providing those services were exempt from the ban, allowing them to remain open on Sundays.
It was actually reported that Żabka Nano even outpaced Amazon's rollout speed for checkout-free stores in Europe. That's a powerful statement about their ability to innovate and execute quickly in the tech space.
It certainly highlights their agility in responding to market shifts and regulatory challenges. Building on that tech push, they launched the Żabka mobile app in 2020, which saw incredibly rapid user growth, quickly reaching over 10 million users, a massive digital base.
The first physical Żabka Nano store opened in June 2021 at the Poznan International Fair, almost like a proof of concept, right? And they even piloted one at the Tesla Gigafactory near Berlin in late 2022, showing international ambition for the format.
And a very recent significant step is the concrete international expansion into Romania, announced in late 2023 and launching stores under the Fru brand in 2024.
They have ambitious initial targets there, 200 stores and 175 million revenue by the end of 2024.
Yeah, and importantly, they acquired a local distributor, DRIM, to build a dedicated logistics support structure right from day one. Smart move.
They're also continuing to diversify their service offerings, like adding mobile phone repair services, which was announced in early 2024. It's another step towards being that mini service and retail center.
All of this momentum culminated, as we mentioned, in the IPO on the Warsaw Stock Exchange on October 17, 2024, under the ticker ZAB.WA.
Major event.
Huge. The fourth largest GPW IPO and the fourth largest in Europe that year. The offering price was PLN 21.5 per share, and it traded up nearly 7% on the first day, showing strong investor interest.
And CVC is still the largest shareholder post-listing, around 40%, right?
Yeah.
Confirming it's not just an exit, but a move to secure capital for future growth.
Exactly. It strategically positions Żabka for the next phase of expansion and further investment in technology and digital capabilities.
We should definitely mention the leadership team, too. While Mary Switalski had that crucial initial vision,
yeah, the significant transformation we've seen in recent years, particularly the rapid scaling, digital push, Romania entry, and the IPO, has largely been overseen by Tomasz Suchecki. He's been president and CEO since March 2016.
His background includes extensive retail experience, right? Geronimo Martins, the Biedronka parent.
That's right, which gave him deep market knowledge. He's been recognized for his leadership in driving this change, picked up some awards.
He talks about fostering a culture of ambition and openness within the company. And you can see how that management ambition, combined with the strategic injection of private equity funding, enabled this kind of dramatic scaling and innovation.
What's truly fascinating here is how deeply ingrained that trait of adaptability appears to be throughout Żabka's history. They've consistently shown an ability to not just weather external challenges like that significant Sunday ban, but to strategically respond in ways that actually push them into new areas.
Like pioneering autonomous retail or leveraging those service exemptions.
Exactly. It turned a potential weakness into a catalyst for innovation. Really quite remarkable.
That adaptability seems like a key part of their DNA. Okay, so we've seen how they grew and adapted. But how does this tech-powered convenience ecosystem actually work on a day-to-day basis? And importantly, how do they make money from it?
Right. At its heart, Żabka's business model is built around delivering that ultimate convenience through this integrated ecosystem. And they have quite a few ways they bring in revenue. It's definitely more than just selling groceries over the counter.
What's a primary revenue driver? Is it still the physical stores?
Absolutely. The foundation remains the sales from franchise convenience stores. The vast majority of their network, around 9,000 franchisees operating about 10,500 Polish stores, are run by independent entrepreneurs.
Okay.
Żabka Group is the primary supplier of products to these stores, and its core revenue comes from the margins on those products they sell to their franchisees. The franchisee buys the inventory and operates the store, though they can add some regional items sourced locally.
Okay, so it's a supply-driven model for the core network. What about the food side? Quick meal solutions and Żabka Café.
That's a very strategic and rapidly growing category for them, focused on-the-go food and drink. Think hot snacks, coffee, sandwiches like tomsio paluk, and ready-to-eat meals under brands like Samam.
Yeah, I've seen those.
They've aggressively rolled out ovens into over 90% of stores and are actively developing more sophisticated formats like Żabka Café 2.0. It's their major push into capturing a bigger slice of the, street food or quick service restaurant market from a convenience base.
And I've seen their own brands like Wysisk juices and Foodini snacks. Do those offer better margins?
Generally, yes. Private label products typically yield higher profit margins for the group compared to national brands, and they also helped differentiate the offering and build brand loyalty. Makes sense.
The in-store services also seem crucial, and not just for revenue, right?
You're right, they're important for revenue through fees, but critically they drive foot traffic and keep the stores relevant for multiple errands. Parcel delivery and collection, for instance.
Ah, that was key for the Sunday opening thing, wasn't it? The postal service exemption.
Exactly. Instrumental. They also offer utility bill payments, cash services acting much like an ATM for deposits and withdrawals, lottery tickets, gift cards, and, as we mentioned, even mobile phone repair services now. The goal is for each store to function as a mini service and retail center.
What about the Żabka Nano autonomous stores? How do they fit in revenue-wise?
The Żabka Nano autonomous stores are a distinct revenue stream from product sales within those unmanned 247 locations. Customers enter using a card or app, AI and sensors track what they take, and they're automatically charged upon exiting. It's a different operational model, but still it's sales revenue.
And then there's a whole digital push, the digital customer offerings, or DCOs.
This is a major strategic growth area for them. They have a bold target of roughly a 5-fold increase in revenue from this segment in the medium term. Huge ambition.
5-fold? Wow. What does that include?
It includes their direct-to-consumer D2C prepared meal business, Maczfit, the online meal plan marketplace, Dietly, and their e-grocery platforms, Żabka and Dietly, which are supported by dedicated dark stores for fulfillment.
Okay, so the franchise-related income itself, like the initial fee to become a franchisee, that's probably a smaller part of the picture compared to the ongoing product supply model.
Exactly. The core financial relationship is through that supply model. One report mentioned franchisees receive about 16.5% of the store's revenue to cover their operating costs, with the remainder, after the cost of goods, contributing to Żabka Group's income.
And they're even getting into advertising, leveraging that foot traffic.
Yes, leveraging their massive daily customer traffic of around 3 million people. Through Żabka Ads, their retail media network, they sell advertising space on in-store digital screens. This generates advertising revenue and allows brands to target customers based on data. Pretty smart use of their assets.
So the franchise model is clearly powerful for rapid scaling without huge capital outlay for Żabka Group, enabling that vast network. But it also means sharing some of the store-level revenue and relying heavily on those independent franchisees for execution and customer experience.
Right.
That reported franchise turnover of 16% in 2023 definitely sounds like something they need to manage closely.
It's an inherent trade-off in the model rapid reach versus some level of operational control and, relationship management. But let's zoom out and think about the value proposition. Given all these different pieces, what does Żabka actually offer to different groups?
For customers, it seems like the overriding promise is ultimate convenience.
Oh.
How do they deliver that? What does that mean in practice?
Well, it breaks down into several layers. Proximity and accessibility is huge, the always nearby perception, thanks to that incredibly dense network, with many stores within a 300, 500-meter radius in urban areas. That's hard to beat.
Okay.
Then there's speed and efficiency, quick shopping trips designed for busy people. Extended opening hours, typically 6 a.m. to 11 p.m., plus 247 with Nano, and being that comprehensive one-stop solution for multiple errands in one visit.
Their stated mission aligns perfectly, making people's lives easier by helping them free up their time.
Exactly. Plus, they offer a modern and evolving product range, those QMS options, fresh items, own brands, adapting to food trends, and a technology-enhanced shopping experience via the Żabka app features and the Nano experience.
And for the franchisees, what's the value proposition there? Why would someone sign up?
It's about providing an accessible path to entrepreneurship with a recognized, strong brand, often with a lower barrier to entry than starting completely from scratch. They offer a comprehensive support system covering setup, stock, supply chain, marketing, technology, and training. It's about empowering local entrepreneurs with a structured business model.
In terms of who is Żabka for, their target customer audience seems pretty clear.
Yeah, primarily time-constrained urban and suburban consumers who value speed and accessibility for their daily needs, meal solutions, and services. It caters heavily to impulse purchases, top-up shopping, and the grab-and-go food market. And increasingly, they're focusing on digitally savvy users who engage with the app and online offerings.
And franchisees are aspiring entrepreneurs, maybe with limited prior capital or experience, looking for that structured turnkey business. The sources note the diversity in the franchise base, which is interesting, including Ukrainian citizens.
Geographically, Poland is the core home market, obviously. That extensive network, strategically spread, density is a key advantage.
That 300, 500-meter radius reach you mentioned.
Precisely. Romania is the key new international market entry in 2024, with ambitious plans to replicate that dense network strategy. They're focusing on major cities there and leveraging the acquired DRIM distributor for logistics. There's also that intriguing Nano pilot in Germany.
Right, at the Tesla Gigafactory.
Hinting at potential future CEE expansion, building on their historical but divested presence in Czechoslovakia.
Okay, so we understand the model and who it's for. How do they actually deliver all this? What's the operational engine that makes the ecosystem work behind the scenes?
An absolutely crucial component is their advanced logistics network. It's highly efficient and largely managed in-house. In Poland, they have 8 logistics centers and 19 transshipment terminals, including that modern automated center near Warsaw.
Impressive scale.
Yeah, and they report impressive operational KPIs like 95% of deliveries handled internally and a 99% service level to stores, which is vital for maintaining stock. They're also incorporating sustainability into logistics, looking at electric vehicles and transport management systems, or TMS, to optimize routes.
And technology integration seems to be woven into every aspect of their operations, not just customer-facing tech like the app.
That's right. Technology is a core strategic pillar. Their Żabka Future unit is dedicated to driving innovation. AI plays a significant role behind the scenes optimizing site selection for new stores, crucial for ROI.
Right, picking the winners.
Yeah, personalizing assortment in stores, dynamically adjusting pricing, and powering the operations of the Nano stores. The Żabka app is the central digital gateway unifying the customer experience. They also collaborate with external tech partners like A5 for the nanotechnology and NetGuru for digital development.
And managing that large franchise system has to be a major operational task in itself.
It is vital for scale. They rely on standardized processes, comprehensive initial and ongoing training, and providing daily operational support. They have a franchise council for dialogue and are developing digitized store management tools to simplify operations for the entrepreneurs.
And finally, the continuous store development and format diversification. They're not just cookie-cutter stores.
No, definitely not. They have an aggressive rollout strategy, targeting 1,000 or more new stores annually. They also work on diversifying store formats, tailoring them to specific locations, whether it's a neighborhood shop, one in a high-traffic area, a seasonal location, an office building, transit hub, or those innovative nano and even drive-through formats.
If we connect the operational dots, you see how heavy technology investment creates, manages, and optimizes the whole ecosystem. AI for critical decisions and efficiency. Żabka as primary interface. Nano pushing boundaries.
Yeah.
And digitized logistics. Well, they're absolutely essential for enabling both the vast physical network and supporting those e-grocery dark stores.
And the data generated from all these touch points creates a feedback loop, right? For continuous improvement in everything from assortment to promotions to understanding customer behavior.
Yeah.
And the DCOs and services diversification isn't random. It's a deliberate strategy to capture a wider share of consumer spending, build resilience by not relying solely on traditional retail, leverage the strong Żabka brand and existing customer base.
Penetrate adjacent markets like meal kits and e-grocery.
Exactly. Create more customer touch points, enhance the data they collect, and ultimately foster deeper customer loyalty. It's all part of embedding that convenience into more aspects of your daily life.
Exactly. It's a complex, interconnected machine designed to deliver convenience across multiple fronts. Now, let's place this within the broader industry and see who they're competing with in this dynamic space.
Right. The market context is substantial. In Poland, the total retail market is estimated somewhere between PLN 584 and 615 billion. Big number.
But as you mentioned earlier, Żabka's core focus is its directly addressable market, modern convenience, e-grocery, and D2C catering. That's where they play.
Right, that dam is smaller, around PLN 113 to 123 billion, but here's the critical point. It's forecast to grow much faster than the broader retail market. We're talking a CAGR of about 8.6% for Żabka's dam, compared to roughly 4.6% for the total market.
Nearly double the growth rate. That's significant. And that dam in 2024 was about 4.5 times Żabka's current end customer sales, so there's still significant growth potential within those specific segments they target.
Key trends in Poland strongly support this focus on convenience. We see ongoing urbanization, increasingly fast-paced lifestyles, growing demand for food-to-go options, and rising incomes supporting impulse buys. Digital engagement is high.
Yeah, lots of people using retail apps and loyalty schemes.
Exactly. Technology adoption, like unmanned stores, is also slowly but surely happening. And notably, other players like Dino Polska are also experimenting with automatic store concepts.
The Sunday trading ban, introduced in 2018, remains a major trend that significantly shaped the market. Żabka's adaptability in using postal services and pioneering Nano allowed them to navigate it, although the regulatory future around Sundays is still uncertain, isn't it? With planned limited Sundays in 2025.
Yeah, that uncertainty persists. And price sensitivity remains an important factor for consumers, especially in the current economic climate after periods of inflation. People are looking for value.
How about Romania, their key new market? What's the context there?
Romania is seen as a very attractive market for expansion. It's the second largest consumer market in Central and Eastern Europe, with consumer profiles that Żabka sees as quite similar to Poland. It has strong GDP growth and real wage growth, boosting purchasing power.
And they see untapped potential.
Huge untapped potential for convenience there, estimating the market could support up to 4,000 stores long-term. Key trends in Romania include a strong focus on price and promotions, discounters like Kaufland and Lidl gaining share, a nascent e-grocery market that's still small but growing, and a shift towards more planned shopping alongside demand for urban convenience and indulgence items.
So who are they up against in this environment? It sounds like the competitive landscape is quite diverse, hitting them from multiple angles.
It absolutely is. In Poland, you have other traditional convenience store chains. Some are large franchise or affiliated networks like ABC, Louisen, Groszczek, Odito, and Shorten.
Right, those are familiar names.
Others are banners like Carrefour Express or Spar Express. They vary widely in terms of their modernization and operational sophistication, though.
You've got the forecourt retailers like the dominant state-owned Orlen, plus BP, Shell, and Circle K, who are increasingly building out their convenience retail and food offers at high-traffic fuel stations, competing directly on grab-and-go.
Definitely. And the big players, of course, are the supermarkets and discounters like Biedronka, Lidl, and Dino Polska. While they compete intensely on price for the overall grocery basket, some, like Dino with its automatic store, are also starting to push into convenience formats or technology that overlaps with Żabka's space.
You also have dedicated e-grocery players like dissect and others who compete with Żabka's Juice and Delio, and naturally the entire QSR, quick service restaurant, food delivery sector, and specialized D2C meal services compete for the same food-on-the-go or meal solution spend that Żabka targets with its QMS and Maczfit offerings. It's crowded.
Very crowded. Market share figures vary depending on how you define the segments, but Żabka claims dominant leadership with 22% in its defined directly addressable market. Other estimates put them around 5% in the broader Polish food retail market, or roughly 20% within the convenience sector specifically by late 2024.
So regardless of the exact number, they're clearly a very significant player, particularly in modern convenience, leading by store count versus their nearest non-fuel competitor like Carrefour Express.
Absolutely. So in this crowded and diverse space, what gives Żabka an edge? What are their competitive advantages, the sources of their economic moat, as they say?
What protects them?
The sources point to several key areas that are difficult for competitors to easily replicate at scale. Firstly, their brand strength and that unparalleled network density in Poland. High brand awareness, over 90%, combined with having over 11,000 stores, creates that always nearby perception. It's a huge barrier to entry for others to build a comparable physical footprint, and it creates a powerful network effect.
They also benefit from significant economies of scale and process efficiency. The sheer size of their network gives them advantages in procurement, marketing spend, and leveraging that sophisticated in-house logistics system. Using AI for things like site selection and managing store operations further contributes to cost advantages and efficiency.
Their advanced technology integration and data analytics is a core differentiator. This isn't just marketing, it's embedded strategically. AI for key decisions, the scale of data harvested through the Żabka app and loyalty program, pioneering concepts like Nano. Building this level of tech capability and integrating it across operations is complex and expensive for rivals.
The efficient and capital-light franchise model allowed them to expand rapidly, leveraging local entrepreneurs' capital and drive, which is hard to match if you're building everything corporately.
And the diversified convenience ecosystem, bringing together physical stores, QMS, services, digital ventures, and retail media, creates multiple touch points for the customer and is starting to build what we call nascent switching costs, especially when unified through the Żabka app. The more services you use through Żabka, the stickier you become, yeah.
Makes sense. They also have that proven adaptability and innovation culture, which is a difficult thing for larger, more rigid organizations to replicate. Their response to the Sunday ban is a prime example, as is pioneering Nano.
And the experience management team overseeing this complex operation is clearly a strength.
So how do they specifically differentiate themselves? What makes them stand out from, say, a traditional small shop or a discounter?
It's their relentless focus on ultimate convenience delivered across those multiple channels. They have a strong and continuously expanding QMS food-to-go offering that goes beyond typical convenience store food. They are actively building that direct digital customer relationship through the Żabka app, moving towards a super app concept, and they are pioneering genuinely innovative formats like Nano and drive-through.
The qualitative assessment from the source points to Żabka possessing a moderate and widening economic moat.
Yes, that assessment is based on those primary pillars we discussed.
Yeah.
The strength of their brand and network, their scale and operational efficiency, and their advanced technology and data capabilities. The developing ecosystem adds those nascent switching costs.
But the durability depends on.
Right. The key question for the durability of that moat is whether they can sustain their pace of innovation, effectively manage the franchise system, successfully counter competitors coming from multiple angles, e-grocery, QSR, discounters, adapt to the regulatory landscape, and reinforce their value proposition against pure price competition.
Focusing on that faster-growing, directly addressable market seems strategically smart, allowing them to compete where convenience and tailored offerings are key, rather than trying to beat discounters solely on price for a commodity basket.
Absolutely. That blurring of lines between retail formats means more opportunity for Żabka to expand its reach, but it also means a broader and more varied set of competitors to contend with.
Okay, let's look at the financial side of things. Keeping in mind, this is a conceptual overview focusing on trends from the provided information and definitely not investment advice.
Right. Crucial reminder. This gives you a picture of their financial health and trajectory based on the sources. The overall historical trend shows significant and consistent growth.
That's the narrative that comes through strong, sustained, double-digit top-line revenue growth. We see figures like a 25.9% compound annual growth rate between 2021 and 2023, over 20% growth in their fiscal year 2024, and continued positive growth in early 2025.
The drivers for this are clear. Their aggressive new store rollout, positive like-for-like sales growth from existing stores, and the increasing contribution from those digital ventures and new service categories. A key metric they track, which captures the scale of the whole ecosystem, is sales to end customers.
Right. That includes everything going through the system.
Exactly. And they have an ambitious target to more than double this figure between 2023 and 2028.
On profitability, gross margins seem healthy for the retail sector in the range of 17.8% to 19% between 2021 and 2023.
Yeah, pretty solid. And adjusted EBITDA, which is a measure of operational profitability before things like interest, taxes, depreciation, and amortization, that's shown strong growth, often faster than revenue.
Which suggests improving operational leverage, right? Better cost management.
Yeah, exactly. For fiscal year 2024, adjusted EBITDA was up nearly 24%.
And the adjusted EBITDA margin is a key focus area for them, with a stated aim to operate towards the upper end of a 12-13% range. They hit 12.8% in FY 2024.
Yes, driven by factors like enhanced efficiency, cost optimization, including lower energy prices compared to previous periods, and the benefits of scale.
But importantly, the net profit margin has been historically thinner compared to those strong EBITDA margins. Why is that?
That's a crucial point to understand. The reasons relate to the structure of the business. The franchise model involves sharing revenue at the store level. There's significant depreciation and amortization, D&A, from all that heavy investment in new stores, refurbishments, and technology infrastructure. And they've also had costs associated with servicing their debt.
Okay, so structure, investment, and debt costs.
Right. One analyst note highlighted a net profit margin around 1.8% in 2023, attributing it to these factors. Żabka has a stated goal to improve their adjusted net profit margin towards 3% in the short term.
It sounds like Q1 is typically the weakest quarter in terms of net profit due to seasonality, sometimes even showing net losses.
That's correct. Retail often sees slower activity early in the year compared to the peak summer months. But looking at the full fiscal year 2024, adjusted net profit was up significantly, nearly 66%, so improvement there.
On the debt side, they have historically operated with significant debt levels, including lease liabilities, which are common in retail with so many stores.
Yes, but active deleveraging has been a clear strategic priority for the group. The net debt to adjusted EBITDA ratio has shown a positive downward trend. It improved from 2.1x at the end of Q1 2024 to 1.6x a year later, and stood at 1.5x at the end of Q4 2024.
And their medium-term ambition is to reduce that ratio further, aiming for below 1x.
Exactly. Below 1x is the target. And that PLN 1 billion sustainability-linked bond issued in May 2025 was part of a strategy to diversify their funding sources, not necessarily to increase net debt overall.
So the overall financial narrative that emerges from the sources is one of a company in a phase of aggressive growth and strategic investment. They are actively balancing that rapid expansion with efforts to enhance operational profitability and strengthen their financial structure through deleveraging and focusing on improving that net profit margin.
That sums it up well. The franchise model aids expansion and EBITDA growth, but the net profit is clearly influenced by the model structure and ongoing investments.
What are the key financial metrics someone watching Żabka should really be paying attention to based on this?
Okay, key things to watch. Like-for-like LFL sales growth is crucial. This measures the health and performance of existing stores, stripping out the impact of new openings. A positive LFL shows they're successfully growing sales within their established base. They target mid to high single digits, and FY 2024 LFL was 8.3%. Good indicator.
Sales to end customers is that broader metric we mentioned, giving you the total value sold through the entire ecosystem, which is a great way to track their overall penetration and scale across all channels.
Adjusted EBITDA and adjusted EBITDA margin tell you about their core operational profitability and efficiency before accounting for things like financing costs or non-cash charges like depreciation. Monitoring these shows the underlying business performance trends.
The number of store openings network growth is a direct indicator of their physical expansion pace and market penetration. They target over 1,000 new stores annually.
Digital customer offering, DCO revenue growth, is absolutely key for tracking the success of their diversification strategy into those high-potential digital channels. They have that ambitious target of a 5x increase medium term. Gotta watch that one.
The net debt to adjusted EBITDA ratio is vital for understanding their financial risk profile and deleveraging progress. A falling ratio indicates improved financial health in relation to their operating profit.
And the payback period for new stores is a great efficiency metric. How quickly does a new store recoup the initial investment? They've shown significant improvement here, reducing it from 20 months in 2017 to 12 months in 2023, indicating they're getting better return on their physical expansion capital.
How is capital generally used at Żabka? Where are they putting their money?
It's heavily weighted towards reinvestment for ambitious growth. The primary focus is on growth investments. expanding the store network in both Poland and Romania, significant investment in store refurbishment, and rolling out new concepts like Café 2.0 or street food areas, developing the digital infrastructure for their DCOs and Żabka app, and upgrading their crucial logistics and core technology infrastructure.
Debt reduction is also a stated priority, aiming for that lower ratio.
Yes, that's part of strengthening the balance sheet to support future growth. For shareholders post-IPO, given this strong focus on reinvestment, you shouldn't typically expect significant immediate dividend distributions.
Right, the value is meant to come from growth, not payouts.
Exactly. The primary return is expected to come from capital appreciation, the value of the company increasing as a result of successfully executing these ambitious growth plans and increasing market share.
And some of their capital allocation is linked to achieving specific ESG targets through that sustainability-linked bond.
Overall, the financial profile is clearly growth-oriented. Returns are driven by scaling the ecosystem and gaining market share, not through immediate cash payouts to investors. The improvement in the store payback period is a positive sign for the efficiency of their core physical expansion capital deployment. And seasonality means you need to look at full-year or longer-term trends rather than getting overly focused on a single quarter like Q1, which is typically weakest.
Okay, this gives us a solid financial picture. Let's wrap up our analysis by using a framework to summarize the key internal and external factors of SWOT analysis. What are their core internal strengths?
Starting with the strengths, what Żabka does particularly well internally. Number one is arguably their dominant market presence and brand recognition in Poland. That network of over 11,000 stores, over 90% brand awareness, processing 4.1 million transactions daily, it creates a ubiquity, that always nearby perception, which is a huge asset and barrier to entry.
Tied to that is their advanced tech integration and data analytics. They are genuinely positioning themselves as tech-powered. Using AI for critical decisions like site selection, assortment, and pricing, the scale of data from the Żabka app, the innovation with Nano, and that dedicated Żabka Future unit are significant strengths.
Another key strength is their efficient and scalable franchise model. It enabled that rapid, capital-light expansion across Poland by leveraging entrepreneurial drive supported by the group's system.
Their sophisticated in-house logistics and supply chain is also a major strength, crucial for serving such a large network efficiently and consistently. Can't run 11,000 stores without good logistics.
No way. And that diversified ecosystem, bringing together QMS, services, digital offerings, DCOs, and retail media ads gives them multiple revenue streams and ways to interact with customers beyond just traditional retail.
They have a proven, strong track record of growth and improving operational profitability, showing consistent top-line and adjusted EBITDA growth and demonstrating improved investment efficiency, like reducing the store payback period.
And that embedded adaptability and innovation culture we discussed, seen in their response to the Sunday ban and pioneering Nano, is a vital internal strength against external challenges.
Plus, the experienced management team guiding this transformation.
Definitely. Now, turning to the weaknesses, the internal challenges or areas for improvement.
A notable one is their dependence on franchise performance and satisfaction. Because the stores are run by independent operators, the consistency of the brand experience and operational execution relies heavily on thousands of individual entrepreneurs. Managing that relationship effectively is complex.
Related to that is franchise turnover. The reported 16% turnover rate in 2023 is a definite weakness. It can be disruptive, costly to recruit and train new franchisees, and can impact brand consistency and store performance. That's a number to watch.
We discussed the relatively thinner net profit margins compared to their strong adjusted EBITDA. While they're working to improve it towards 3%, it's structurally impacted by the franchise model's revenue sharing, high depreciation from investments, and debt servicing costs.
Historically, they've had significant debt levels, including leases. While they are actively deleveraging, the historical debt and the fact that goodwill exceeds equity, noted by some analysts, can impact financial flexibility and net profitability.
Managing the complexity of a diverse ecosystem, operating disparate business lines like physical stores, multiple digital platforms, and various services creates operational challenges that need careful management. It's a lot of moving parts.
It really is. And there's the potential for channel conflict as their e-grocery operations, Delio, expand. They need to carefully manage how these digital channels interact with and potentially cannibalize sales from the physical stores. It's a tricky balance.
Moving on to opportunities, positive external factors they can potentially leverage for future growth.
The continued strong growth in overall convenience demand is a major tailwind. Secular trends like urbanization, Faster lifestyles, rising income, and demand for food on the go provide fertile ground in both Poland and Romania. The wind is at their back there.
International expansion, especially the push into Romania, represents a significant, relatively untapped market opportunity. Success there could open the door for further expansion across Central and Eastern Europe. Huge potential if they get it right.
There's substantial potential for further development of their digital customer offerings. Achieving that 5-fold revenue increase target in DCOs and successfully leveraging the Żabka app as a central super app for engagement and upselling is a huge opportunity.
Expanding their high-margin categories like QMS, street food, coffee, and own brands can improve overall profitability. That makes sense.
They also have the opportunity to better leverage their vast customer data. Analyzing data from the Żabka app and store transactions can drive personalization, improve marketing efficiency, and optimize operations and assortment planning. Data is king.
Ongoing technological advancements present opportunities for further operational efficiencies through AI and automation, or potentially scaling innovative concepts like Żabka Nano if the economics and technology prove viable for wider deployment.
A growing focus on sustainability, ESG, can be an opportunity to enhance brand reputation, build customer and franchise loyalty, and potentially de-risk operations. People care more about this stuff now.
And there's always the potential for strategic partnerships or acquisitions to accelerate growth in specific product or service areas, acquire technology, or enter new markets. Could be a shortcut sometimes.
True. Finally, the threats, negative external factors they need to navigate.
Competition has to be high on the list.
Intense competition is a constant threat. They face vigorous competition across multiple segments, not just other convenience chains and forecourts, but also discounters pushing price, QSRs for food to go, online grocers, and D2C meal services. The potential for persistent price wars from discounters is always present.
Changes in consumer behavior and trends, or a broader economic downturn inflation, could reduce disposable income, increase price sensitivity, and negatively impact sales and margins. External shocks.
Regulatory changes are a significant threat, particularly the ongoing uncertainty around the Sunday trading ban in Poland, whether it might be liberalized or potentially tightened again. Other regulations related to franchising, food safety, environmental standards, or taxation like excise duties can also impact costs or operations.
There are market saturation concerns in Poland, where the network is already very dense. This raises questions about the long-term potential for physical store growth in their core market. How many more can they really fit?
Good question. Broader geopolitical instability, like the war in Ukraine, creates economic uncertainty, impacts sentiment, and can cause supply chain disruptions.
Given their reliance on technology and data, cybersecurity risks and data breaches are significant threats that could cause disruption, financial loss, penalties, and severe reputational damage.
Yeah.
It's a big one for any tech-heavy company.
And general supply chain disruptions, unrelated to geopolitics, can impact product availability and costs.
And specifically post-IPO, there's the potential share overhang, where major private equity shareholders might decide to sell more of their remaining shares, which could potentially put pressure on the stock price.
Right, that's always a factor after a PE-backed IPO. But as you noted earlier, Żabka's history shows they are adaptable. Their strategic response to the Sunday ban, for instance, is a prime example of how they've previously managed to navigate a significant threat.
That adaptability is a key asset in facing many of these external threats. And it's important to remember that many of these risks are interconnected. For example, franchise issues can impact strategic execution, or regulatory changes can intensify competition.
Exactly. That interconnectedness is key to understanding their approach to risk management. Żabka has a multi-layered mitigation strategy embedded within a comprehensive enterprise risk management, or ERM, program.
Okay, how do they try to manage these, like the franchise risks?
They focus on ongoing dialogue, providing financial and operational support, particularly during the startup phase, robust training programs, referral schemes, benchmarking franchise revenue, and investing in automation and robotization of some in-store duties to simplify the franchisee's role, trying to make it easier and more attractive.
And for IT system disruptions and cybersecurity, which is critical given their tech focus.
They have regular training and awareness programs for employees, constant network monitoring, anti-DDoS measures, secure penetration testing, patch management processes, an information security management system aligned with ISO 27001 standards, and business continuity plans. Standard, but crucial stuff.
Financial risks like debt, currency.
They maintain diversified funding sources, both long-term and short-term, monitor interest rates and FX exposure, though not always hedging FX, use measures like virtual power purchase agreements or VPPAs for electricity to stabilize energy costs. Credit risk from supplying inventory is managed through inventory pledges, credit verification, monitoring, and a business insurance policy. Liquidity is managed through detailed cash flow projections, planning, reverse factoring arrangements, and access to credit lines.
Okay, comprehensive. What about market and strategic risks? Competition, new ventures.
They actively monitor key market indicators and competitor activities, continuously develop new product offerings and strategies, use AI tools for optimizing store location and investment decisions, and conduct thorough due diligence for any new ventures or acquisitions.
And regulatory and legal risks like that Sunday ban.
They have active monitoring of the external legal and regulatory landscape. They have an established risk and compliance committee and internal working groups dedicated to assessing potential impacts and developing responses to changes, staying ahead of it or trying to.
And for ESG-related risks, meeting those sustainability goals.
They focus on monitoring the deployment of their initiatives, testing technological solutions for sustainability, rigorous reporting on their ESG ambitions and KPIs. They have a dedicated ESG team, and importantly, they link ESG KPIs to the remuneration of management and key managers, providing a financial incentive to meet those targets. Put your money where your mouth is, basically.
The existence of this comprehensive ERM program, which they state is aligned with their strategy, planning, and objectives, shows they are thinking about these risks in a structured way. The system involves various governing bodies, internal audit, and aims to involve employees at all levels to increase awareness and ensure appropriate responses. It includes their compliance system with codes of ethics and conduct, a whistleblowing channel, and training.
It seems they recognize the complex web of risks and have put a multi-layered set of systems and processes in place to try and manage them as they pursue their ambitious growth. That multi-layered approach reflects an understanding of those complex interdependencies we discussed.
Okay, let's bring this deep dive to a conclusion. What are the key takeaways?
Well, Żabka Group has successfully transformed from a traditional Polish convenience store chain into a sophisticated, tech-driven convenience ecosystem leader, dominant in Poland with ambitious plans for Romania and significant digital potential. It's a journey shaped by rapid expansion, adaptability in the face of challenges, strategic private equity support, and that landmark IPO.
The core strengths that emerge from our review are clear. That unparalleled physical network and strong brand awareness in Poland, the efficient and scalable franchise model, their strategic and advanced use of technology and data, a sophisticated logistics operation, the diversification into a wider ecosystem of offerings, a track record of significant growth and improving operational profitability, and that proven culture of adaptability. A lot going for them.
But they also face notable challenges. Effectively managing the large franchise network and addressing turnover, the intense competition across multiple segments, potential market saturation concerns in Poland for physical stores, managing their financial structure to improve net profitability despite investment and debt costs, and navigating external factors like the economy and regulation. Significant hurdles.
How would you characterize Żabka Group for someone looking at it from an investor perspective? Based on all this, what kind of company is it?
Primarily, it's a growth-oriented company. Their capital allocation is heavily weighted towards reinvesting in expansion, building new stores in Poland and Romania, significantly developing those high-potential digital offerings, the DCOs, and continuously enhancing their technology and logistics infrastructure.
Right.
The financial strategy supports this growth focus, aiming to drive increases in total sales through the entire ecosystem, sales to end customers, and operational profit, adjusted EBITDA, while also explicitly working on improving net profit margins and reducing leverage over time.
So shareholder return isn't focused on big, immediate dividends then?
Not typically, no. Given the focus on aggressive reinvestment for future scale and market share gains across physical and digital channels, significant immediate dividend distributions are not the expected model. Value creation for shareholders is anticipated to be driven by capital appreciation, the increase in the company's value over time, resulting from the successful execution of its ambitious growth plans. It's a bet on future growth paying off.
What does future success for Żabka Group really hinge on? What needs to go right?
Okay, key things. It hinges on their ability to successfully and profitably scale their operations in Romania, proving that the model can be replicated internationally. That's a big one. It depends crucially on the continued growth and effective monetization of their digital ecosystem, particularly achieving that ambitious DCO growth target.
Making the digital side really work financially.
Exactly. The effectiveness of the Żabka app evolving into a true super app that unifies the customer experience and drives engagement is key. The scalability and economic viability of the Żabka Nano technology could also be a significant factor down the line. Continued operational efficiency gains from their investments in AI and automation are important. And critically, their success depends on their ongoing effectiveness in managing the inherent risks of their franchise model and navigating that dynamic, multifaceted, competitive landscape.
So Żabka Group is a market leader in a resilient and growing convenience sector that is actively using technology and diversification to shape its future, pushing beyond traditional retail. Understanding its business model, the key drivers of its growth, the competitive environment it operates in, and the risks it faces is essential for comprehending where the company stands today and where it aims to go.
Well said. Now, to leave you with a thought, Żabka's vision is really about embedding itself in your daily life, making things easier and freeing up your time. This raises an interesting question. As technology enables convenience to reach into more and more aspects of our lives, how far do you think a company focused on convenience can really go in becoming your personal ecosystem? And what does that mean for how you shop, live, and interact with businesses in the future? Something to mull over.
Standard disclaimer. The content provided in this presentation is for informational and educational purposes only and should not be construed as financial or investment advice. Investing in stocks carries risks, including the potential loss of principal. Viewers should conduct their own thorough research and consult with a qualified financial advisor before making any investment decisions. The creators of this content are not liable for any actions taken as a result of any information presented.